Millions of Americans wake up every morning in a country that promises prosperity, but delivers panic. A nation with a $28 trillion economy, yet most families can't survive a $500 emergency. Groceries rise faster than paychecks. Rents devour half of a worker's income. Credit card interest crosses 22%, while savings accounts sit at zero. Parents skip meals so their children can eat. Workers take double shifts just to fall further behind. This is the new America, where people simply can't afford to live in the country they're working to survive. America is entering an era where financial stability is no longer the norm, but a statistical rarity. The world's richest country sits on a $38 trillion federal debt, with households collectively carrying over $1 trillion in credit card balances. Most Americans are surviving on razor-thin margins, with no cushion between them and financial collapse. Nearly 63% of workers cannot cover a $500 emergency, exposing a system where one broken appliance, one medical bill, or one tire blowout can force a family into debt that accumulates interest at 22% to 33% APR. What used to be minor inconveniences have now become life-altering setbacks because wages have not kept pace with the rising cost of basic survival. Gas prices fluctuate unpredictably. Grocery bills have risen by double-digit percentages. Insurance premiums hit new highs. When everything costs more but paychecks barely move, fragility becomes the default condition. This fragility is not only financial, it is emotional. Constant uncertainty erodes confidence, increases anxiety, and fuels a silent despair. The core issue is the widening gap between what it costs to live and what Americans earn. Essential expenses such as housing, transportation, and healthcare rise faster than wages every single year. Even full-time workers face unavoidable deficits. Small emergencies escalate into long-term debt, and long-term debt triggers higher monthly obligations that suffocate any chance of building savings. As this pressure grows, Americans increasingly rely on credit to bridge the gap, not because of irresponsibility, but because the math simply doesn't work anymore. This is why credit card balances are at historic highs and delinquencies are rising across every bank. Poverty in America is not just a lack of income, it is a financial penalty system that charges the highest prices to the people with the least resources. Poverty is a multiplier of costs. Every essential service extracts a heavier toll from low-income households. Utilities in poorer zip codes often carry higher fees. Car insurance premiums rise simply because of the neighborhoods someone lives in. Rent consumes more than 40% to 60% of income in many cities, forcing families to pay far more for smaller, older units. Even basic banking penalizes the poor through overdraft fees, minimum balance penalties, and high-interest loans that function as traps wealthier Americans rarely encounter. Healthcare is where this penalty becomes devastating. A single emergency room visit without insurance can cost $2,000 to $5,000. Even minor medical issues can turn into medical debt that lingers for years. Poor families postpone care because they cannot afford it, allowing conditions to worsen and costs to balloon. This is why economic hardship directly links to shorter life expectancy, higher stress disorders, and chronic illness. Poverty punishes the body as much as the wallet. America has entered a stage where wealth is no longer separated by a gap, but by a canyon. The distance between the top and bottom has widened so dramatically that the economic ladder millions once relied on has splintered into pieces. The top 10% of earners now make more than 13 times the income of the bottom 10%, a level of inequality that rivals developing nations, not the richest country on earth. This imbalance is not abstract. It has real, measurable consequences on every attempt to climb upward. When the cost of living rises faster than earnings, mobility becomes mathematically impossible for the bottom half of the population. While the wealthiest households saw asset values surge during the last decade through stock gains, real estate appreciation, and corporate bonuses, ordinary families faced rising rents, higher healthcare bills, and an economy where wage growth lagged consistently behind inflation. The pandemic accelerated this divide. Corporations with deep cash reserves responded to labor shortages by offering retention bonuses and increasing pay for high-skill roles. Meanwhile, small businesses and public sector employers lacked the resources to match these adjustments. As a result, the inflationary wave strengthened the financial positions of upper-income groups, while simultaneously eroding the purchasing power of everyone else. The inequality index rose dramatically in a single year, reversing a decade of slow improvements. This isn't simply a story of the rich rising faster. It's a story of economic floors collapsing beneath millions. When entry-level workers earn wages that fail to cover basic expenses, savings become unattainable. And without savings, even minor shocks trigger financial descent, not ascent. The ladder isn't broken because people refuse to climb. It's broken because the rungs are now spaced too far apart to reach. The economic foundation of the United States is cracking because the price of survival has detached completely from what employers are willing to pay. According to MIT's calculations, a basic living wage for a family of 4 now requires $24.16 per hour per adult. Yet the federal minimum wage remains stuck at $7.25, unchanged for more than a decade. The gap is catastrophic. Even jobs paying $15 an hour, once considered decent entry-level wages, no longer cover modern expenses. Housing alone consumes half of many workers' income. Healthcare deductibles reach into the thousands. Childcare rivals the cost of monthly rent. Transportation, utilities, and groceries rise faster every year. When essential costs outpace earnings this aggressively, financial stability becomes mathematically impossible. Workers aren't failing to budget. The economy is failing to provide the income required to make budgeting meaningful. Over the past few years, the price of food, transportation, and energy climbed far faster than wage growth, leaving workers poorer in real terms despite nominal raises. When the real value of a paycheck collapses, families lose the ability to build savings, cover emergencies, or plan for the future. The result is a permanent state of financial tension where survival requires constant trade-offs. The economy increasingly relies on low-wage labor, while withholding the compensation needed to sustain that labor. Millions work long hours in physically demanding roles, yet remain unable to cover basic household needs. This disconnect fuels turnover, stress, and burnout. It also pushes families toward credit dependence, feeding directly into the rising national $1 trillion credit card burden as workers swipe their way through unavoidable shortages. As wages collapse and costs surge, millions seek support from systems that were never built for a modern economy. America's safety net was designed in a different century, calibrated for a world where rent was cheap, groceries were affordable, and healthcare did not require thousands of dollars just to walk through a hospital door. Today, those same programs operate with outdated formulas, forcing families to navigate assistance structures that barely acknowledge 21st century living expenses. Monthly cash support for low-income households is often shockingly small. In many states, a family of 7 receives roughly $250 in welfare, an amount erased instantly by a single grocery trip in an age where basic food staples cost double what they did just a few years ago. SNAP benefits fail to match actual food inflation, leaving millions short every month. Medicaid eligibility cliffs create a cruel paradox. Earning even a small raise can trigger the immediate loss of healthcare coverage, punishing households for attempting to improve their situation. These benefit cliffs are one of the most damaging flaws in the safety net, pushing families to remain below income thresholds to avoid catastrophic benefit losses. The way America measures poverty is fundamentally broken. Thresholds used to decide who qualifies for assistance come from formulas created in the mid-1960s based on the cost of a minimal diet. That calculation made sense in an era when housing, childcare, and healthcare were a small portion of household budgets. Today, those categories dominate monthly expenses. Yet the official measure still relies on a framework frozen in time. This outdated formula produces an illusion of progress by counting only pre-tax income, ignoring the reality of what families actually take home after payroll deductions, healthcare premiums, and rising living costs. The Supplemental Poverty Measure, introduced in 2011, attempted to correct some of these issues by adjusting for housing costs and including government assistance. While more realistic, it still falls short. It does not fully incorporate modern childcare costs, medical insurance gaps, or state-level food inflation disparities, meaning millions who are economically insecure remain invisible in federal data. This measurement failure has real consequences. Eligibility for crucial programs depends on classifications that undercount struggling households. Policymakers rely on these numbers to allocate billions of dollars, meaning flawed metrics lead to flawed decisions. Policy is the only proven tool capable of lifting millions out of hardship. During the pandemic, federal programs expanded. Emergency stimulus lifted 45.4 million Americans out of poverty under the Supplemental Poverty Measure, one of the fastest and largest reductions in economic hardship in modern U.S. history. The transformation of elderly poverty through Social Security and Medicare reduced senior poverty from near 40% to about 10% today. Without those programs, nearly 4 out of every 10 older Americans would fall below the poverty threshold. Yet, despite these successes, most anti-poverty measures remain temporary, limited, or tied to political cycles. The expanded child tax credit of 2021, which cut child poverty nearly in half, expired after a single year. As economic pressure intensifies and policy support rises and falls unpredictably, millions turn to coping behaviors that quietly reshape their financial lives. Financial instability rewires how people think, plan, save, and spend. Lifestyle creep begins subtly when a small raise creates a brief sense of relief, often translating into small upgrades. Dining out more often, subscription stacking, entertainment splurges. These upgrades feel harmless at first, but once routine, reversing them becomes emotionally difficult. For others, emotional spending becomes a coping mechanism for chronic financial anxiety. When wages fail to cover basic necessities and stress accumulates, small purchases provide temporary psychological relief. But these purchases accumulate into revolving credit card balances with interest rates over 22%, feeding the same debt system that keeps families financially trapped. America is entering a debt spiral unlike anything seen in modern history. With wages lagging behind the cost of survival and financial stress reshaping behavior, households are relying on credit not as a luxury, but as a lifeline. This is how the country reached $1 trillion in credit card balances, the highest level ever recorded. Americans are using high-interest debt to pay for basic needs, not discretionary wants. Credit card interest rates now exceed 22% on average, while retail cards climb beyond 29%, with some hitting 33%. At these levels, even a modest $2,000 balance can balloon into thousands more in accumulated interest, trapping households in long-term repayment cycles they cannot escape. As incomes fall short of essential expenses, credit becomes the default solution, turning short-term gaps into permanent burdens. More than 70 million new credit card accounts have opened since 2019, reflecting the growing number of people forced to bridge financial shortfalls with borrowed money. For many families, debt repayment now competes directly with housing, transportation, and food, essential categories that cannot be reduced. This conflict accelerates delinquency rates, which are rising across major banks and retail lenders, early indicators of widespread financial strain. The exhaustion of pandemic savings has added fuel to this storm. The temporary cushion that once softened the blow of inflation, job instability, and rising costs is gone. Without that buffer, households are vulnerable to even the smallest financial shock, And with interest rates at historic highs, the cost of borrowing becomes heavier every month. This rapidly building debt storm means the question is no longer whether financial pain will spread, but how soon it will transform into a full-scale economic crisis. For months, analysts repeated the same phrase: the American consumer is resilient. But resilience has an expiration date. When wages stagnate, when savings evaporate, when credit becomes the primary survival tool, resilience mutates into quiet collapse. America is now standing on that cliff edge. Household spending is still high, not because families are thriving, but because they are borrowing aggressively to maintain basic living standards. During the holiday season, shoppers prepared to spend nearly $900 each, despite rising delinquencies, rising balances, and rising interest rates. Historically, credit card debt falls after the holidays as households pay down their bills. But recently, the debt never dropped. It stayed elevated, signaling that repayment capacity has been exhausted. Major retailers are sounding alarms. Macy's and Nordstrom both reported surges in missed credit card payments, a warning that consumers are no longer able to keep pace with their obligations. These early delinquencies often precede broader financial distress, spreading from retail cards to mainstream credit, auto loans, and eventually housing. The financial structure of the average household is now mathematically unsustainable. A $6,000 average credit card balance, a $400 to $600 student loan payment, soaring rents, insurance premiums climbing across every category, and the lingering shock of inflation in groceries, utilities, and transportation. When essentials exceed income, collapse is no longer theoretical, it becomes unavoidable. The return of student loan payments is pushing millions even closer to the edge. Combined with high interest rates, families have fewer tools left to stabilize themselves. The slightest emergency, a medical bill, a car repair, a rent increase, can trigger a chain reaction that ends in default, eviction, or long-term debt entrapment. This consumer cliff is not just a household crisis, it is an economic warning. When the spending power of the middle and lower classes breaks, the broader economy follows. America is approaching a moment where the consumer, the engine of 70% of the US economy, can no longer sustain the illusion of strength. The fall has already begun, and the impact is what comes next.